We take a look in this video at the FNB Property Broker Survey for the first quarter of 2021 and specifically the rental market component of that. Now, for the three major property sectors, i.e. office, industrial and retail, the first question we ask is for their perceptions of market activity in the various three sectors. And what we see is that the industrial sector is perceived as the strongest one in terms of market activity, as well as being the most improved since the lockdown quarter, i.e. the second quarter of last year. So on a scale of 1 to 10, they give their perceptions of activity, and the activity rating for the industrial property sector went up from 4.5 as at the second quarter of last year to 6.51 in the first quarter of this year. A less significant but still noticeable improvement was seen in the retail property sector, 3.62 as at the second quarter of last year to 5 in the first quarter of this year. But unfortunately, the office sector has shown no meaningful recovery. As a matter of fact, the activity rating has declined since the second quarter of last year from 3.7 then to 3.49 as at the first quarter of 2021. So the office space really becoming the weak part, the really soft part of the commercial property sector's major sectors. We then asked them questions with regards to vacancy rate trends. And the one I want to quote here is where we asked them for their perception of whether vacancies have increased, decreased, or stayed the same over the past 6 months prior to the survey. And what we do is we assign a score to the increase, decrease, or stayed the same ratings, and we build it into an index with a positive index level, meaning rising vacancy or a bias to rising vacancies over the past 6 months. And probably no surprises, the office sector's got the strongest positive index value of 56.4 on a scale of minus 100 to plus 100. So that's a very strong bias towards vacancy rates have risen over the past 6 months. The retail sector, a far lower bias towards vacancy rates have risen, plus 13.3. That's not too significant. And the industrial property sector, actually for the first quarter in a while now, a negative value, minus 18. In other words, there's a mild bias towards vacancy rates have declined over the past 6 months. So by that score too, the industrial market is the healthier and the stronger market of the three major property sectors. It's very interesting because if one looks at some of the economic data related or strongly linked to the industrial property sector, it hasn't shown a wonderful picture up until very recently. So manufacturing, obviously a key driver for the industrial property sector, manufacturing gross value added, still as at the fourth quarter of last year, minus 2.1% year on year down. So the manufacturing sector in a year on year growth recession still as at late last year. Inventories, which are the key driver of warehouse space, we've seen, according to the economic data, economy-wide inventory levels dropping quite sharply for the last 2 years, and especially till late last year, still in decline. So that doesn't really point to a drive, or as at last year, for increased warehouse space when you're depleting inventories. This is typical during recessionary conditions, as you do run down inventory levels. We've seen manufacturing capacity utilization relatively low in recent quarters, so that didn't give a source of optimism for industrial property. And even though building plans passed by last year had almost halved from what they were, this is now square meterage of building plans passed in the industrial property space from what they were in 2018, almost halved. But the building completions coming online last year were still at an elevated level. They hadn't really started to drop yet meaningfully. So as at late last year, it all pointed to a weak drivers, economic drivers of demand for industrial space and fairly strong supply coming online. So this is a pleasant surprise, I guess, when you start to see brokers telling us that vacancy rates may be starting to decline. And I guess what they're seeing is more recently what we might be seeing in the Manufacturing Purchasing Managers Index. When you look at the sub-index of that for new sales orders, we start to see signs, a leading indicator of manufacturing growth, manufacturing production, possibly starting to move back into positive territory. Now this new sales order part of the Purchasing Managers Index, it's on a scale of 0 to 100, and in recent quarters it surged up to 60.4. 50 is the dividing line between contraction and expansion, so 60.4 is a pretty healthy number, and it suggests that we may now be in line for positive growth in the manufacturing sector. And that can be the only indicator that I can quote or cite which points to, or which maybe tells us that this is what the brokers are seeing. We're starting to experience the early signs of restocking of the economy, inventory starting to be accumulated again, manufacturing starting to grow positively again, and an increase in demand possibly for industrial property space. Industrial property is also the most affordable of the three property sectors, and the most adaptable. So it can also be that businesses looking for more space for cheaper space for online retail and such structural changes to the economy are coming in greater numbers. But something certainly positive is happening in the industrial property space at the moment. Now, I think what this points to is that industrial property may get it right to stay, by and large, out of all-out national rental deflation. Roeder report for the first quarter of this year points to 1% positive growth in industrial rentals. That's not a wonderful number, but it's not negative. But office space, I think, looks like in the near term going deeper into rental deflation. Already the Roeder report pointing to a -5% year-on-year decline in A-grade office rentals, and that could still deteriorate further, I think, before it gets better if we look at this broker survey and how strongly biased they are towards vacancy rate rising trends and weak activity levels in that sector.